I mean, my advice is to just keep at it. I think it's important to just get going and get started. And that's why I think, we see a lot of women translate sort of their angel portfolios into venture. Maybe they have a fund zero, a fund one. Maybe before you have an institutionalized fund, it's really just about getting points on the board, building your network, getting in with founders, really zeroing in on how you operationally support your founder ecosystem and kind of what your secret sauce is. I think it's hard to do that in theory. So get started, keep going, find early allies, and continue to improve sort of this funding flywheel for women. And it's going to take a lot of us.
Hey everyone, this is Prashant and I'll be your host for the VC10X podcast. And today we have Nevin with us. Kate is president of TSWII Capital Advisors and portfolio manager for both TSWII and TSWS, focused on investments in hedge funds, venture capital, and other alternative strategies. Her career has spanned more than 2 decades, beginning as an analyst in New York City in the early 2000s with Lehman Brothers. After marrying and relocating to Charleston, SC, Kate joined TSW, where she has been actively managing portfolios for over 20 years. In this episode, we talk about Kate's story and how she started investing, having a multi-asset class investing approach at TSW2, managing liquidity and long-term investments within the portfolio, how investments in the next 30 years will be done differently than they have been done in the past 30 years, investing into diverse GP teams with at least 50% female GPs, her advice for female fund managers, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast10X, where I help VCs start and run their own podcast. While I was running VC10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Kate, so good to have you on the VC10X podcast. How are you doing?
Great, Prashant. Glad to be here.
Yeah, it's a pleasure having you on. To start things, can we first have your story and how you started investing?
Sure. Well, I feel like any good story, it's winding and full of surprises. But in hindsight, I think all those different experiences were the whole point, right? To give me the tools that I have for this exact moment in time, when I find myself doing exactly what I think I'm supposed to be doing. But originally, I know we're here to talk about investing, but originally I thought I would be a writer. So after college, I ended up working for a consulting firm, drafting research for Fortune 500 companies to pull together white papers that would help them sort of improve their best practices as relates to sales and marketing. But it didn't take too long before I realized that was not the type of writing I had anticipated doing after college. So I moved to New York City, and I thought that was really where I would kick off this, career as a novelist, the great American novelist. But then I actually ended up taking a crazy left turn and got a job as an analyst at Lehman Brothers. That was early 2000. So that was a wild time. That was a pretty remarkable time to kind of step into that world. And I feel like ultimately, joining as an analyst at Lehman Brothers was about as far away from being a novelist as you could get. But it was really informative, and I was surprised at how much I enjoyed it. I ended up as a sales and trading analyst, and was able to select the team I wanted to work with. So I worked with hedge fund clients through prime brokerage, and I sort of had a loose association with hedge funds, just from attending hedge fund partnership meetings with my dad as I was coming through college. And so that was a language that I sort of spoke and really found quite interesting. So it was a great opportunity to dig in. Um, and I mean, I certainly could write a book about those days, but ultimately, my time there was cut short by 9/11. I think I probably could have stayed all the way through until, Lehman Brothers ceased to exist. But 9/11 really reprioritized a lot of things in my life. And so I had already left the city by 2008. I was actually in the maternity ward. My son was born September 15th, 2008, here in Charleston, South Carolina, where I'm based now. So I was watching the news as Lehman filed for bankruptcy, and that was a wild time. And really was pretty formative, I think, in my early experiences and my understanding of markets and risk. I mean, to go from 9/11 and also have the GFC and all these really remarkable touch points early on in my career was, goodness, like, I mean, just pull back the veil, right? Stepping into everything all at once. And I think that was really remarkable in terms of cutting my teeth and understanding risk, and thinking strategically about ultimately what I wanted to do and sort of how I viewed the investment world. And one of my favorite quotes in terms of Lehman Brothers was Christine Lagarde's, who said, if it had been Lehman Sisters instead of Lehman Brothers, the world might look a little bit different these days. And so I think that also kind of informed how I, am, in terms of being a woman in a field that was predominantly, at least, in particular in the early 2000s when I was coming through, was really male dominated. And so thinking strategically around, her quote and what that means, and really, building a career, and stepping more into really cultivating that, I think, more exposure and more connectivity in the ecosystem for women in investing. Anyway, I think that was a ramble, but in a lot of ways, ultimately from 9/11 by 2008, I had found myself back in the South, working for TSW2 Capital Advisors, which is actually the firm, where I would attend those partnership meetings with my dad. It was our sort of family business, family office. So, full circle, but in a kind of a circuitous way. I might never have anticipated. It really wasn't my intention to come back and support the family office, but I feel like it's kind of the textbook hero's journey, right? You go out, you face some obstacles, you learn a few things, you have an adventure, and then you make your way back home. And so that's really kind of been an interesting tale in terms of where I started and where I ended, but a remarkable 20 years. So I don't know, that might have been a little too long in the tooth on how I started investing. But I think those experiences, ultimately shape who we are as investors, right? How we see the world, how we communicate, how we interact. And so I wouldn't have had it any other way. Those were some pretty remarkable events to have, so early in my investing career.
Absolutely. That's truly an incredible story there. And completing with you being at TSW2, where you're working right now, and you're doing all different kinds of investing into different asset classes. So tell us more about what is TSW2 and what's the mission here.
Sure. So TSW2, the letters TSW actually come from the original family business, which was stove manufacturing. Over 100 years ago, my family launched a wood burning stove manufacturing company called Tennessee Stove Works. And so out of nostalgia, we kept that TSW. I remember early on in some of my investment days, I'd go to cap intro conferences and other investment conferences, and they would type out the entire name of the firm. So it's a Tennessee Stove Works. And I feel like people were always like, what is she doing in the room? I don't know why this stove woman is at these cap intro meetings or these, investment, sitting in on these investment panels. But that was the origin story of our family business. And then, sort of in a very organic way, that um, really almost by accident sort of launched the next operating company, which is now today called TSW2 Capital Advisors. And the story of that is that really, the stove company was eventually sold in the late 70s. And my dad actually had, by 1980, he had the minimum investment for to be an LP in Julian Robertson's Tiger hedge fund, which at that point was really, I mean, the OG, like really early in the hedge fund space. And when he made that investment, my grandparents, aunts, uncles, I think everyone basically back in Tennessee thought he was nuts. Like, what's a hedge fund? This sounds super risky. I don't know what you're doing. We don't want to be a part of it. But clearly, I mean, those early years, the performance was astounding, right? I mean, it really was an interesting way to take advantage of the market with, controlling the market exposure, managing for volatility, managing for, investments that and for those listeners that don't know, I'm sure most of them do, but the original Tiger hedge fund was a textbook long short equity hedge fund where you're buying stocks that you think are going to go up and you're shorting stocks that you think are compromised in some way, shape, or form, and will go down. And that alpha is sort of what you make. That's sort of the alpha beyond the market, so you can control your exposure to the market. And those early years were really quite exciting. So of course, family members wanted to invest in Tiger after they kind of saw how this worked and really got comfortable with the process and how the investment mandate and thesis played out. But at that point, it was closed to LPs as a 3C1. So TSW2 was actually created as an access vehicle for Tiger Hedge Fund. And that launched a more broad sort of portfolio of hedge funds and ultimately other asset classes. So, kind of fast forward from 1980 to 91, when the firm was sort of officially structured as a fund of funds to allow for family to access Tiger, other Tiger, I think there were a couple other funds at 101 Park, a handful of other early hedge funds, some private equity. So really early on, sort of had this family office, sort of, I would say, a family office sort of philosophy around investing in terms of this is the bulk of our family assets. We also, started working with other families, endowments, foundations, high net worth, but really my family was the foundation of this portfolio. And so really had that alignment and I think that long-term orientation that most family offices had, which made it a bit different. Really early on, we took sort of the endowment model approach, and that, you want to concentrate in the right assets, but you also recognize that diversification is important for controlling risk. So we tend to be more concentrated in our highest conviction hedge funds, but also have private equity, venture capital, other ways to sort of manage the risk return profile we're looking for ultimately. And and so that's really sort of been the driving force is sort of how do we want to invest as a family and how are we going to manage our long-term investment horizon? Where do we think we're going to find the best alpha for the risk return profile, and how are we going to execute that across the portfolio? So we tend to be more liquid than illiquid. We tend to be about 70%, liquid to the extent that some of these hedge funds and long only vehicles are liquid, and then around 30% in illiquid strategies, which are predominantly private equity and venture capital. And so now we've been doing this for over 30 years, and I feel like it's been, since inception, a pretty strong way to compound our family capital.
Absolutely. Thanks for sharing that. That was very insightful on how the family office has now matured and is kind of an asset management company in itself, investing alongside other uh, endowments and firms like that and other LPs, right? And also the insight into how you have diversified into liquid and illiquid asset. That's also very insightful. So one thing that I read on your website, which was a note from the president, that is you,
That is me. That's
and it
me.
said, yeah, that's you. And it said that you believe that how investments were done uh, the past 30 years is very different from how they need to be done in the next 30 years. So can you expand on that for our audience?
Sure. I mean, I think we all, as investors, wish we had some sort of crystal ball and we watch, all sorts of factors, macro factors, company reportings, earnings, all of that, and try to put together a mosaic of what we think is going to happen over the long term. And we all have different ideas around that. But the one thing that I feel like I can truly say for certain, if there was only one thing this crystal ball was showing me, it's that the next 30 years are going to look a lot different than the last 30 years. And what I mean when I say that is just, the rate of change is astonishing these days. I think about just sort of in my lifetime, what's changed in terms of technologies, democracies, migration, demographic shifts, climate, equality, healthcare. I mean, everything. The rate of change is more and more rapid. You throw in things like AI and, these tiny little screens we're attached to in our hands. I mean, every day almost feels like a brave new world. And so while I think you can sort of have generational and long-term frameworks for a portfolio in terms of how you might want to manage, asset classes or liquid versus illiquid, those sort of structures can stay in place. But in terms of the investments and the managers and the founders and the ecosystems, like those, I feel like continuously need to be refreshed, right? Where are the people that are really tapping into this complex society we live in that has so many challenges, but then the flip side of that is so many opportunities, right, to solve for those challenges. And so I think it's really important that my investment approach reflects this, right? We might stay in that sort of 70 liquid, 30 illiquid, that feels comfortable, but then drilling down deeper into how I'm reflecting sort of my current views, how does that show up in the portfolio? And I think that there's a quote that I love by a theologian, Frederick Buechner, and he says, "The place God calls you to is where your deep gladness and the world's hunger meet." And I don't think it's a stretch to say that's also almost like an investment philosophy as well. Like when I think of my deep gladness, it's like my insight, right? Like kind of how I'm paying attention to the world, how I'm analyzing the risks and returns as I see them come across my desk. And then the world's deep hunger is sort of what's happening, right, on the ground, what's happening in terms of technology, AI that we can solve for. So when you kind of combine these things in a Venn diagram, I'm really trying to get to that centerpiece where I feel like I have a bit of insight around the opportunities, challenges, and the investors that will best execute on those strategies. Which I guess ultimately, everyone's trying to do. But I feel like now more than ever, we need to really make sure we're tweaking our approaches, our pipelines, our ecosystems, our networks to really set us up for success over the next 30 years. I used to joke that whatever apps were on my kid's phone, I needed to invest in. Like, who's like the early adopters, really making sure those people are in my network, those deep thinkers, making sure I'm paying attention and not getting so stuck into this zone of like, well, I've been a portfolio manager for, 25 years. I know what I'm doing, right? We've got a system that works. Like, I think we constantly need to be retweaking our approaches. And there's an economist I love, Dr. Pippa Malmgren, and she says often something like, those who love solutions will be the winners in the next economy, not those who love money. And I think that's true. I think if you really are into finding a solution, right, whether that's healthcare innovation, climate tech innovation, an incredibly useful tool for consumers, then that should scale well, right? So I think it's like taking that solution to the next level and really thinking about who are the people that are going to find these solutions. And, data shows that those that are closest to the problems will usually be the ones that find the solutions, right? So I think that also turns the sort of the demographic shift on its head, that a lot of these founders, a lot of these really insightful managers are going to be part of this demographic shift, right? Like, I think that's why I'm constantly paying attention to more women as managers, as founders, people of color, like this sort of new approach to a lived experience they've had, and then solving for that, or reflecting all of that insight into how they build their portfolios, how they build their teams, how they build their cultures. So that's really, in terms of the next 30 years, like that's really what I'm thinking about a lot. And that's the super fun part of my job, right? I mean, I'm not a futurist, but I love futurists. I love thinking about like, what is the future of work, the future of care, the future of investing, the future of access, all of these things that you pick apart with other people on your podcast, right? But I really do think that as asset managers, we should be thinking about this new world that we live in every day. It becomes more and more complex and more exciting in a lot of ways in terms of how to invest around this pace of change.
Absolutely. We do call it investing, but it's honestly just how well you understand the world and where it's headed, right? And you just use that to direct your investments, right? And if you are good at observing the world and predicting where it's going to go, then you're going to be a good investor, right? It's very, very
Right.
correlated that way, right?
Right. Yeah.
Awesome.
Yeah.
And yeah, good point on how asset managers always need to be learning, right?
Right.
Regardless of how big of a fund or how old of a fund you're managing, you always have to be learning to be able to find the next big thing and to
Right.
keep producing those returns for your LPs and for yourself, right?
Right.
And you mentioned about how 70% of your fund is invested into liquid assets and 30% into illiquid, that is private equity VC, right?
Right.
So why have you kept it this ratio? So give us a brief overview of what's the risk return profile of
Mhm.
liquid asset classes versus illiquid asset classes.
Mhm. So, we've always had a priority for liquidity as needed. I mean, I think, clearly the risk return profile difference is that there's a premium for longer duration capital, right? So you expect that if you're going in earlier, if you're locking up your capital, there's going to be a bigger return down the road. And so that really means that you've got to be aligned with the time horizon of that investment, right? It could say 7 to 10 years, but as we saw in 22, when things get dislocated, it could be 10 to 12, 10 to 15, right? And so you really need to make sure that your horizon, your investment needs are aligned with that. And so we've always felt that it's important to have this more liquid sort of market based investment as well. I think that helps in terms of compounding over time, having ability to add and take out money when you feel like depending on the investment environment, it gives me more ability as a portfolio manager um, to make asset allocations to the portfolio in terms of how, again, going back to that comment of how I see the world, right? So I have more flexibility in that liquid book, quote unquote, to really kind of play more current thesis and also make, long-term bets there too. I mean, of course, there are managers in the portfolio that we've been invested in since the 90s, and they continue to innovate and put up good returns. And so it's not sort of this trading, modality. It's really long-term investment, but that liquidity piece has always been important. Again, kind of going back to the family office, right? If somebody needs an annual distribution, we want them to be able to have that. I don't think locking up people's capital for an eternity makes sense. So, we've always been more comfortable living in that sort of endowment, you know, uh, approach where we're trying to make sure we're matching up sort of this public market exposure, sort of be utilizing both a top down and a bottom up sort of there, as well as saying, okay, in terms of the illiquid, tending to focus more on the private equity or the later stage, so that there was a closer time horizon to liquidity there as well. It's only really in the teens, 2016, 17, where we really started looking more in the earlier stage. And I think there's a place for that too. So it's really managing liquidity, time duration. And then, of course, you can kind of overlay what are you trying to accomplish with these investments too? What's the actual investment memo mandate, differentiation value add of this particular manager. And so once we kind of have the frameworks in place, then, can really use in particular venture to really dive deep into some of those, more values aligned, maybe more impact focus areas. I think it's a little bit easier to do that explicitly in venture, but not exclusively, right? We are able to execute some of that more values aligned investing on the public side of the portfolio as well, the liquid side. But for us, trying to create this evergreen structure, right? Which we have an evergreen structure that continues to be a source for family and investors to compound capital over time. That mix of asset classes was really important in context of that liquidity profile. And that's sort of how it sort of came to be organically in the 90s, and that's kind of how we continue to use that, right? To have this sort of longer duration capital with a little bit higher return expectation against this public portfolio or liquid portfolio where we have more concentrated exposure to who we believe are the most talented managers, and then a little more flexibility to move assets around there while we kind of keep this long-term view on our on the more sort of venture private equity side.
Absolutely. That's very interesting to learn your approach on that front. And talking about the VC asset class specifically, so if you're making LP deployments into VC funds as a limited partner, what are you really looking for in them? You mentioned you are more interested in somewhat later stage and have been interested in somewhat earlier stage as well, starting 2016, 2017. So give us a sense into what are you really looking for in VC managers when they're pitching you?
Sure. Right now, I mentioned it earlier, but I'm really looking for increasing the pipeline of female managers, or at least teams that are at least 50% owned by females. I really want to see more exposure And for me, just in terms of the data I've done, it seems to be there's also this sort of performance boost in these more diverse teams, right? And that goes across asset classes. I've seen it in hedge funds and private equity, and I've also seen it in venture. Um, and venture is, by and large, there are more women in venture than in any other asset class, right? So while I'm constantly keeping the funnel and the pipeline wide open across, I do see there are a lot more women in venture, and more women tend to be in the earlier stage too. So I think in terms of the overall context of, I have a wide aperture. I can look at any opportunity, and that's, for better or worse, it keeps me super busy, but I get to look at almost anything that comes across my desk that seems interesting. I can double click on it. But given the alpha proposition, and again, sort of where I think the world is headed over the next 30 years, I really have been spending a lot of time diligencing female owned teams. Really, and I like to see sort of diverse teams, right? Like a culture and an org chart that I think is reflective of that rigorous investment curiosity and lived experience, and different backgrounds. So that's sort of high level. Um, but I'm also able to focus a bit more on that sort of impact and values aligned space with venture as well. I mean, more explicitly. So outside of trying to really cultivate diverse teams and diverse ownership, I'm also, looking at certain sectors that I think are going to check the box on sort of where I want my investments to go. We're looking at, what clearly in all investments, what's the differentiator? What's the value add? What makes this team special? And not necessarily trying to focus only on track record or a particular fund number. Also really challenging myself to do diligence differently. So trying to find really top talent, high talent, but not kind of just having a check the box system on diligence, right? Like, I feel like we miss a lot of really remarkable managers that way. So, we're willing to do, look back at their angel portfolio deals, do a little bit more on the reference check side, talk to more of the founders they've worked with, some of the LPs, their previous teams. And so really spending more time there and really digging into the ecosystem of a manager. What else is sort of in top of mind? The basics. Domain experience. We want to see a really, deal by deal understanding, sort of, were they driving those deals? How close were they to these investments? What's the track record to every deal they've made? Typical, we have all those sort of typical intake forms on, how much they've deployed, net IRR, MOIC, TVPI, all those typical things. But then I think really in terms of bringing up this next batch of talented, top quartile, top decile managers in my portfolio, I need to dig a little bit deeper and not rely on just sort of this, the more those that get a bit
The
more
metrics.
yes, exactly, right. I think really digging into the ecosystem and talent that lives just below the surface and keeping that pipeline open. And so we're looking at private equity, we're looking at later stage. And I think just because the pipeline is so big in the earlier stage, we're also spending more time there. And I've built up some diligence protocols with my team so that I can utilize other team members to help me do that, because it is such a wide aperture. So really trying to put some structure around every meeting and how we move these managers through the diligence chain.
Absolutely, that's very interesting to learn. And so you must be, like you said, you must be getting pitched a lot from GPs, and a lot of GPs trying to raise from you. What's kind of the activity you're seeing there, and what's the approach that most GPs take And what's the approach that the best GPs take that helps them stand out just by the way they are approaching?
Hmm. Um, I put a lot of value into sort of the warm intro and the ecosystem that we can build. Like it's really nice to, I rely a lot on my LP colleagues and other family offices and investors that I've met through some early as serving on some LPACs or some early conferences, and find that we're really quite aligned. So I think it's super important to lean on those peers that have an investing approach that's similar to your own, right? So that's been super helpful. That's not the only way, but that is a great source of having these new GPs come in from other LPs I know, and then also from other GPs, right? So I think there is a tight ecosystem, particularly around more diverse managers, really wanting to sort of share fellow GPs they're aligned with, or people they came through an accelerator program with, or it's sort of that network effect, but finding different networks, different ecosystems. Um, but I really do try to make the time with my team to make an intro call with anyone that at a very high level sort of checks our boxes on diverse ownership, diverse teams, focus areas. Really don't want to miss anyone. That takes a ton of time. So it's only a 30-minute intro, and that GP's got a lot to cover in those 30 minutes, right? So I think it's helpful too for the LP to be as constructive early on with the GP. So we actually have a really basic form of just some, would take a GP less than 4 minutes to fill out. A lot of it we can find from their deck. So I love to get a deck ahead of time because I want to know straight away, is this not a fit for a couple of structural reasons that we're not going to be able to work around, right? And so that could be it's just too small of a fund, right? We have a minimum fund size. There's no diverse ownership. The org charts aren't very diverse. Like really trying to make it easier for those entry conversations. And then from there, I think in terms of that 30-minute intro call, really the ability to speak very well, particularly in the terms of venture, to what differentiates their portfolio from others, right? That might be in the same space, whatever if they're a sector fund or if they're more generalist, like what's different about their sourcing, what's different about their background, what's different around the way they support their founders, what's different about the way they built their advisory or the ecosystem, how they support founders beyond just maybe, with the sort of scaling dynamics. Are they doing more in terms of building out the ecosystem? I think it's really important to see ecosystem builders. I mean, we all can get in our silos and we need to stay focused, but I think there's a lot of interesting stuff just happening kind of right out of our field of vision sometimes. And we need to be in a position where we can pay attention to that as it might be a dynamic data point for how we're sort of doing the investment. So I really love to see GPs that are involved in building a broader ecosystem, whether that's the sector they're in or diversity, bringing up more diverse managers. So yeah, I mean, it's a lot to cover in 30 minutes. And I think really just having a deck that's super clear, having the bullet points, the elevator pitch, anything that makes the GP understand, in 15 minutes or less what makes this particular venture fund different and why it should rise to the top in terms of the diligence perspective. Um, I don't like getting and I guess probably everyone can say this, but there's a certain level of persistence which is helpful, and a certain level which is too much, right? So just lots of emails, all of that. We all have our inboxes. Every single person inbox is just overflowing these days. So I think recognizing that and trying to think of, again, really managing the time of both the GP and the LP in terms of what makes sense in terms of follow-up and outreach, and being cognizant that I feel like I don't know, maybe you too, Prashant, but I feel like every year is just getting busier and busier, and my inbox is getting, it's just fuller, and my schedule's fuller, and my travel and all of that. So really trying to figure out how to do the most impact with the smallest meeting and really clear, specific updates that are timed, I think, well for everyone's calendar.
Yeah.
Yeah.
Absolutely, absolutely. I totally agree with that. So, is there some sort of communication on when the GP who's in conversation with you, when they are going to hear back from you, or you tell them, okay, you can check with us in maybe 2 weeks' time, or is there some sort of communication there for GPs to understand?
Sure. So the way we do it, I'm typically a final close investor, and I make that clear when we meet. I think there's a lot of value for people that can write those checks early and first closes, and I really commend investors that do that because it's super important. But for me, kind of coming from the context of really wanting to keep family and other LPs, it's really helpful for me to get as much diligence through the whole process as I can. So that final close helps me know they've reached their ideal fund size. They'll be able to execute on their strategy. Maybe they have a couple of deals already in the portfolio. Maybe there's a little bit more for me to look at. So that's important. So I always try and make that really clear. And so then the touch points for follow-up usually are, let's talk when you have your first close. Let's talk again when you have your second close. Like, let's track around the big milestones in terms of this raise so that we actually have something meaningful to talk about, right? Did you close, at the end of June because you wanted to make you wanted to close on these two deals. So the conversation is a little bit more grounded in what's happening in real time with this fund and with the LP base. So that's usually how I like to track those follow-ups.
Yeah, that's a great approach. And talking about the VC asset class, how do you approach that? And what are sort of, you talked about there are some minimum fund sizes or fund sizes that are beyond your range. So
Mhm.
what's that sweet spot for you, and why have you kept it as that sweet spot?
Mhm.
And also any fund structures that you prefer, and any fund structures that are no for you?
So we have a $20 million minimum. So that is usually, I think that's been for me, and there's really, not a ton of rhyme or reason around that, but I have seen incredible managers be able to execute at 20 million. And I feel like that for me is just the basic minimum. But then I want to see, we've all the way up to 100 million currently in the um, and beyond in the portfolio. But for me, that's really the basis. And then I'm really trying to solve for sort of four verticals, I guess you could say, inside of the venture portfolio, and that's the climate and ag. And inclusive economy, right? So continuing to build that inclusive economy, the future of space, right? Whether it's future of work or care or family. I mean, really thinking, like we spoke about earlier, like where the puck is going in terms of solving some of these problems. And then women's access and women's health is an area I think that is really ripe for innovation. So, that's also another way for me to funnel, right? I know those four verticals kind of, for the most part, could be the entire venture landscape, but at least by bucketing them in those verticals, it helps me with portfolio management. I don't want to have too many managers in one area. So, there's a lot of art and science to how I'm managing this portfolio because, at firm, at a firm level, we're really, this sort of evergreen structure. So I can manage sort of vintages year over year. I can manage sort of in terms of where, if I'm seeing more in women's access or health in one year, then maybe the next year it's more around inclusive economy. So it's nice because this is an ongoing, it's not like I have to find these venture funds in the next 2 years and then I'm done, right? I'm really constantly, for goodness, the next 30 years we'll be taking this approach. So I think that sort of slow and steady and really measured approach to sticking to my verticals, to sticking to sort of the focus on, a minimum size, diverse teams, that really helps me with the longevity of this you know, multi-decade approach to venture.
Right. Absolutely. And one big part of the focus you have is into female GPs, right? So,
Mhm.
is there any sort of advice you'd have for female GPs out there?
Oh my gosh, just keep going. Just keep doing it. We need more and more female GPs, right? I think, what's
Right.
been so awesome for me is to see that, I think I don't know if it still exists, but for a long time there was sort of this pipeline myth. Well, there just aren't enough women to invest in, and I'm happy to say that is absolutely categorically untrue. I think I've met with you know, over 400, probably closer to 450 female GPs over the last 18 months. And that's just scratching the surface. I'm getting new introductions every day, every week, conferences through networks. So the pipeline is really robust. And, that I think that's a benefit for the overall marketplace, right? That just shows that the pipeline is not broken. I think that really does require female GPs to figure out that value differentiator, right? And really zero in on maybe being strategic around early LP relationships and really have a very finely tuned approach to building that capital and those relationships and that network. Um, but I think it is very inspiring and ultimately very good for portfolios all over the world to see this many women in venture these days. And really delighted to see that the pipeline is not broken. There are lots of points for access and talent here. And so, I mean, my advice is to just keep at it. I think it's important to just get going and get started. And that's why I think, we see a lot of women translate sort of their angel portfolios into venture. Maybe they have a fund zero, a fund one. Maybe before you have an institutionalized fund, it's really just about getting points on the board, building your network, getting in with founders, really zeroing in on how you operationally support your founder ecosystem and kind of what your secret sauce is. Like in a lot of um, I think it's hard to do that in theory. So get started, keep going, find early allies, and continue to improve sort of this funding flywheel for women. And it's going to take a lot of us. But I'm seeing a lot of connectivity between these GPs and in this ecosystem. So I hope that just continues to improve. And I think all LPs should really make sure they're taking a hard look on, is this sourcing coming across their desk, right? Are they connected to these ecosystems? And how can we as LPs really support this next generation of talent? So yeah, I think it's a call to action for female GPs and LPs of all shapes and sizes, because there's a lot of talent out there. And I think these female investors are putting good points on the board and really making dynamic investments. And it's awesome to see that.
Absolutely, totally agree with that, and I see that being reflected in the podcast as well. Recently, I've been interviewing a lot of female GPs and LPs as well. So for the LP segment, we have about a 1:1 ratio for every male LP that we have interviewed. There is also a female LP that we have interviewed, and I think that's a very great thing
Yeah,
for the ecosystem for women, because a lot of the times when they are in these meetings, they have to talk in a room where they're all men, right? So
right.
it's always good to have women there, where you're sitting and you're doing that for female GPs. So that just makes them more comfortable, that there are people like themselves who are there in the LP seats as well and can understand them probably better than male, right? And doing the last main question before we do the rapid fire round, and this is, what's been your biggest learning investing in different types of funds over the years?
Oh, wow. I mean, I feel like I'm learning something new every day. But I think my biggest learning is, in recent years, maybe over the last 5 years, is really the intentionality of paying attention to the liquidity profile of a fund and making sure that I can manage that how I see fit and I'm not too dependent on the manager. So I really try and keep my hedge funds, more liquid and my private investments that's where I'm getting the illiquidity. Like I don't want to see a mismatch, too much of a mismatch happen in the hedge fund portfolio, and that's really been something that has been a major learning in recent years. Is really, really making sure that the liquidity profile of each investment is going to track for the long term, and doing what I can to really control that liquidity at the PM level. So I think in this sort of endowment style approach, multi-asset class approach, that's paramount.
Absolutely. That's great. And now let's do the rapid fire round where I'll ask you 5 quick questions about the LP investments you're making into VC funds specifically, and you have to give 5 quick answers, right?
Okay.
So the first one is, what are the sectors and regions you invest in?
So we'll look global, but predominantly US based. And as I mentioned earlier, we're looking at climate and ag, inclusive economy, future of space, and women's access and women's health.
Awesome. What's the typical fund stage you're interested in?
So we've looked across all stages here. So I would say it kind of depends on the expertise of that manager, but I'm doubling down on the earlier stage funds right now. And then also managers that are solving for that AB, particularly around the diverse founder space, really solving for that AB before. I think we have a pretty good exposure to the later stage and private equity in for the most part, but to really trying to spend more time on the early stage, and then who's solving for the next sort of AB rounds.
Right. And do you invest in fund one, fund twos as well, or
I will,
somewhat later in the journey?
yes, I will do fund ones, fund twos, fund threes. Definitely not afraid of fund ones, just kind of going back to the diligence pipeline. We want to get in at final close, try and understand as much as we can about the portfolio and the LPs and all of that good stuff, but definitely not really in, don't have to check a box on any fund number. We're open to all of them.
That's awesome. What's the typical check size you put in?
Has a lot to do with the assets of the VC fund itself, but I would say the range right now is between 250K and $1 million for the VC side of the portfolio.
That's awesome. And where can GPs get in touch with you in case there's a direct way?
There is a button on my website, and you can send a note there. It will send an email to someone on my team. The website is TSWII.com.
Awesome. It will be there in the show notes. And last one, where can our listeners go and follow you?
I am on LinkedIn. If that's social media, that's the only social media I have. So you can find me there. I'm not super active, but I'm always trying to do better. But definitely can ping me there.
Awesome. The link will again be there in the show notes. Thanks so much for making time for this, Kate. It's been incredible conversation filled with insights. And I wish you happy investing.
Yes, thank you, Prashant. I enjoyed it. Have a wonderful day.
Thank you. Same to you.
Bye.